welcome and thank you for joining us. I'm Vanessa McElrath, the Wealth Management Partner here at ML&R, and on behalf of the rest of the advisors and team here, we just want to thank you for taking the time to join us today. But ultimately, I think we're all here today because the last couple of years, we've all been battle tested as investors. And even the most disciplined investor can experience a little volatility fatigue from time to time. And so for that reason, we wanted the opportunity to address some of the most common questions and concerns that we know many of you are facing. And we wanted to give our clients a chance to hear from some experts on what we've seen in the market over the last 4 to 5 months and how we should think about that going forward from an investment perspective to help us navigate some of this turbulence along the way. And so I'm particularly excited to introduce our guest today, Apollo Lupescu, Vice President at Dimensional Fund Advisors, which many of you know is one of the largest investment managers in the world with over 650 billion of assets under management. And he is one of their most prominent speakers who's delivered hundreds of lectures and seminars to financial professionals and individual investors over various different topics. And, he's dubbed the secretary, quote unquote, of explaining stuff because he really has a unique gift for explaining really complicated issues in a clear and understandable way. And I can really attest to this because I actually worked with Apollo under his leadership at Dimensional right at the height of the 2008-2009 financial crisis. And so during that time, he really developed a reputation for delivering thought-provoking information in a clear and understandable way to really rally the troops in the height of that panic. And Apollo, he's been with Dimensional in their Santa Monica office for over 18 years. And prior to that, he was in academia. He taught at University of California, received his PhD in economics and finance from UC Santa Barbara. And he also holds a BA in economics from Michigan State University, where he competed and coached water polo. And if I know Apollo, he is likely still very active and playing today and probably getting out to do some surfing right across the office there in Santa Monica as well. So without further ado, I want to bring in and turn it over and introduce Apollo.
Hi, Vanessa. Well, first of all, thank you so much for the invitation, and thanks to everyone for taking the time. And it's great to see you. I mean, I saw you last week, and talk about swimming. I actually went to that amazing facility right there in Austin at the Jamal Swim Center, and they do have a water polo team. So
awesome, yeah.
If anybody has an interest in that sport or kids who are interested, it's a great coach, Tom, and plug for him. So anyway. Thanks so much for the again for the invitation. And there's so much to talk about. There's so much going on in the market, and is there a particular place that we should start, Vanessa, or should I just
Let's just start kind of high level. I think everyone we've all experienced this market volatility, and I think even despite the initial COVID outbreak in 2020. Surprisingly, the market kind of rallied significantly over the past couple of years. And now, 2022, we're starting to see much greater volatility. And some of that started with kind of the breakout of the war in Ukraine. We have some other issues going on regarding to inflation and everything. So, can you kind of just break it down? What has caused some of this change where we're seeing this turbulence, and is it really a good idea to even be invested in a market like this, what we're experiencing right now?
Yeah, no, and you're absolutely right. I mean, we have been through so much over the past, couple of years, but also over the past decade. And I think what's fascinating is that as I talk to investors, I think for legitimate reasons, a lot of folks are thinking that, hey, this is different. I mean, this is certainly, we have a war, as you said, in Ukraine. We have high inflation. We have the Fed rising rates. We have all this pandemic is still going on around the world. And this feels different. And in that respect, I have to tell you folks, it is different because certainly in my lifetime, I've never had to deal with a pandemic. My parents have not, and my grandparents did back in 1918, but that was a while ago. So it does feel different, and I think it's legitimate for all of us to feel that this is a little bit different this time and ask these questions. Well, what does it mean to us today? And that's exactly the question that we've kind of looked at. Even as this is different, are there things that we can look back and get some perspectives? And that's what I want to perhaps start in the context of Vanessa's questions. It's different, and how do we think about in terms of what we know and what we might be able to do with our money? So the first thing that comes to mind, and I've studied the markets, quite a bit, is that the nature of the stock market is to fluctuate. That's just always been the case. The nature of the economy is to fluctuate. It's never been a steady up, up, up. It's never been a steady down, down, down forever. It's always been a combination of ups and downs. It's just the nature of the market. And to me, Vanessa, what's been really interesting is that 2 years ago, roughly about 2 years ago, we had this very significant drop in the stock market. It feels like a lifetime ago, but about 2 years and 2 months ago, over the span of about 5 weeks, the U.S. stock market lost about a third of its value, just as the pandemic was taking hold of the world. And at that point, people were really petrified. They're really scared because it felt absolutely different. We've never seen a pandemic, and yet now we have to deal with just being locked down at home. Remember, I don't know about you folks in Texas, but here in Los Angeles, nobody was leaving their homes. Like there were no cars on the road. It was really crazy and terrifying. So a lot of people are wondering, what does it mean to my investments? Because this feels different. We see this significant drop. And that's when a lot of people thought that, again, maybe that's not a good time to be invested in the market. But what's so fascinating is that similar to other situations is the market rebounded. And we'll talk a little bit about why it rebounded and what it means for you today. But the interesting thing about it is that since then, for the past 2 years, we have had unusually low volatility. In other words, the nature of the market is to fluctuate, but over the past 2 years, it has fluctuated a lot less than the historical norm. And I think it's a good place to start because we had that big drop. And after that big drop for the past couple of years, I think all of us as investors, we've kind of gotten used to a market that's been pretty steadily going up and not much to see there. It's going up, and what's the big deal? There's not, everything looked good. And we got used to that. The thing is, that is not the norm. The last 2 years have been a bit of an anomaly. What we're going through right now, this higher volatility, in my view, it is closer to the norm of the market. And what I say this is I'm not looking at the points per se. You see on the news that the Dow is up 1,000 points or down 1,000 points. The points themselves don't matter. What matters is the percentage. Because 1,000 points was the Dow when the Dow was at 10,000. Well, that's 10%. When it's at 30,000, it's 3%. So the same number of points, it's not the same in percentages. And when you look at the magnitude of movement in percentages, what you see is that the volatility of the market right now, it's closer to the historical norm. So the first perspective, folks, that I think it's so important is that we have had a bit of an unusually a quiet market, and this unusually quiet market has kind of made us believe that that's the norm. In fact, it was an anomaly, and now we're kind of returning back to some more normal market. And it's a little bit more choppy than it's been historically, but actually it's a little less on the other extreme that we've had over the past few years. The second thing that I want to mention is that quite often the geopolitical risk is being brought up, and what happened in Ukraine and the war. And frankly, you hear so much about that in the media on CNBC that the war is not good for the market and so forth. And I'll give you just a quick fact. As of today, this is end of May, the stock market drop is pretty much identical to what the drop was the day before the invasion began. So by the end of the 23rd of February, the day before the invasion, the stock market was down about 13%. As of yesterday, the stock market's down about 13%. And in fact, over the first 5 weeks of the invasion of the war to the end of the quarter, the market actually went up about 7%. So the war itself has not generated the market drop that you hear. At least that's not the signal that the market's sending. Rather, what I think it's been the one of the primary reasons we're seeing this drop in the volatility is that in the way we measure the stock market, we place a great deal of emphasis on very large technology stocks. Apple, Amazon, Google, Facebook, and Tesla, together, these five companies, did I put five? Apple, Amazon, Google, Facebook, Microsoft, and Tesla. Actually, there's six. These six companies are a significant portion of the stock market. In the S&P 500, these 5 or 6 companies amount to about a full quarter of the value of the S&P. So about a quarter of the performance of the entire S&P 500 as we measure on the market is driven by 5 companies. And if it's a quarter in the S&P, in NASDAQ, which is another measure of the market, these companies amount to a whopping 40%. 40% or so of the value of NASDAQ comes from 5 or 6 companies. So because of that, what we've seen over the past few months is that the growth that these companies have seen over the past 2 years, being in the pandemic and say, wow, these companies are taking over the world. They really moved up in price significantly, these 5 or 6 stocks. And that has driven the market very, very high. Well, over the past few months, there has been a reassessment of their potential for the future earnings, for the future growth. And when this reassessment happened in the market, the market's kind of been sending a signal, well, perhaps as we get new information, perhaps some of these really large companies might not be in the same position that we thought they were a couple of years ago for a variety of reasons. And that has caused these companies to drop. And in fact, if you look at the average drop of these 5 stocks, it certainly has been significantly greater than the market as a whole, significantly greater. So not all companies in the market are doing badly. I mean, the companies right there in Texas, you look at the energy companies, commodities, they're up a whopping 20, 30, 40%. You have tons of other companies that are doing well, but the way we measure the market, we place such a big emphasis on these 5 or 6 large technology stocks. And when they've done well over the past few years, we were really happy. Now these companies are doing a lot worse than the rest of the market, and we're seeing this drop. So to me, I wouldn't look and say this entire market is doomed. Not at all. I mean, what we're seeing is that we're returning some normal levels of volatility based on historical norms. And this drop has been really caused much more so by a reassessment of the earnings potentials, particularly for a group of companies like Apple and Google and Facebook. And a lot of these have dropped, significant amounts. You look at Facebook is down about 40%. Does it have to do with the war? I don't really think so. I mean, it's because they found that they're in trouble because of Apple changed something on the operating system. They're spending a lot of money on unproven technology. They're not competing as well with TikTok and others. Netflix is down 60, 70%. Is that because of Russia? Of course not. It's because they're seeing the competition in streaming is maybe causing some people to switch to other streaming systems. So to me, when I look at this market, I don't really see anything that is really troubling. I really don't see anything troubling. I just see that there's a normal reassessment of earnings potential for companies, and some of these companies are reassessed down, like the technology stocks that I mentioned. Others are readjusted up, like the energy companies. But that's exactly what I expect the market to do. So in that respect, folks, the volatility in the market right now, to me at least as an investor, it doesn't feel there's something that would cause me to take an action. Not at all. That's just exactly what I expect the market to do.
So you just kind of need to zoom out a little bit and look at really kind of the big picture and not just maybe the mini head bites we're seeing.
Exactly right. And one more thing, Vanessa, I mean, I think it's really important for everybody to understand what is the market, because that question is fundamental. If you think the market is the Dow Jones, when you turn on your radio and you hear the Dow Jones did that, the Dow Jones did that, be aware that in the portfolio and I'm not speaking for ML&R, but a typical advisor allocation that is global in nature, there might be 10, 12,000 different companies that are included in the funds in that portfolio. So you have a global exposure to about 12,000 different companies through these funds. And yet the Dow Jones only includes 30 out of those 12,000. It's a very limited subset. That's not exactly what you have. And if you're going to compare that with the portfolio, the global portfolio, that's not really the most meaningful. So what is the market is a really important thing. And we've seen that the volatility is not quite the same in a global allocation as it is on what you see on the news.
Sure. So obviously the geopolitical factors have somewhat been impacting markets. The other big one that we keep hearing about is inflation and how it's dominating the news. And not only are we hearing about it, but we're actually, we feel it. We see it at the pump or the grocery store. And I was just in your neck of the woods in California, and that's even a whole other level that you guys are experiencing there, filling up the gas pump. So I guess, can you give us some perspective on inflation and, what is the sense of what we should expect looking ahead? What can we do, if anything?
Yeah. And for sure, you're right. You got to experience a little bit. When I was in Austin and I saw like $4 and change for a gallon of gas, I can reflect here. It's almost $7 in Los Angeles. So that's high. I mean, that's kind of crazy high. So inflation, we don't need to read about it. Just show up at the grocery store and you'll see it. But here's the interesting thing, inflation, I have to say, it is very unpleasant. And it's for me and for you, for everybody in this call, because inflation means prices are going up. So the same amount of money that we have is not allowing us to purchase as much as we used to. And that's really bad for us as consumers. So no reason to sugarcoat it. Inflation is bad for consumers. There's no doubt in my mind. It's bad for all of us. Part of it is, you look at the war in Ukraine. It didn't affect the stock market because the stock market is much more about the earnings, the corporate earnings. For years and years down the road. And those are not really impacted by what's going on there, because those are relatively small markets that are really impacting these global companies, American companies, and global companies around the world. But it is impacting right now trade. It is impacting the energy markets. And because of that, even though the stock market has not been impacted, the economy and particularly prices have been impacted by the war in Ukraine. As I said, it's unpleasant to all of us. And as I thought about it, to me, there are two thoughts that came to mind. The first thought is that as unpleasant as this is, prices, the way that we think about them in a free market economy, they tend to reflect the realities of the moment. That's absolutely true. Prices in a free market tend to reflect the realities of the moment. And what I mean by that, you have on one hand consumers, us, buying things, gasoline, for example. You have companies buying things and building, factories, whatever they do. And then you have the government buying things. These three elements, consumers, companies, and the government, reflect what's called the demand in an economy. So on one hand, they're purchasing being made by one of these three categories. That's one side of the equation. The other one is the ability of, let's say, the global economy to produce something that is called the supply side. And in free markets, both of these really matter. And both of these in a well-functioning free market, they tend to adjust to the realities of the moment. And Vanessa, about 2 years ago, the big news wasn't just a drop in the market in the pandemic, but a really, really big news that I got so many calls about was about the negative price of oil. Remember that?
Yeah. Oh, yeah.
If you wanted to buy oil.
Yeah.
Yeah, everybody, a lot of folks in Texas remember that. Oklahoma, Texas. If you wanted to buy oil, you didn't have to pay for it. You gotten paid to just take it. And to me, that the fact that we had a negative price of oil reflected the realities of the moment. At the moment, people were not just driving. They were just stuck at home. Everybody was stuck at home. Nobody was driving. And we're still somehow producing oil. So at that point, you had to do something to get rid of the oil. And that's why the price moved. Today, it's a bit of the opposite. We have a lot of people who want to drive, but we don't produce globally as much. And to me, there's almost a necessity for the price to adjust up. So as unpleasant as it is, the alternative is worse, because the alternative to me is keeping the price of gas very low. And when you do that, what happens is you tend to have people use it not in a judicious way. frankly, if the gallon of gas was $1, when I was in Michigan, I remember delivering pizzas and chasing the dollar gallon, because I just wanted to pay on their dollar. That was my thing. If the dollar was still the price of a gallon of gas, how much gas would you use today? We would drive willy-nilly everywhere. The reality is that at $7 a gallon, I'm a lot more careful where I drive. I used to take these drives to the mountains and go hiking, and I can hike more locally now. I know people are changing some of the habits. Sometimes they're even like, I'm going to bike to work. But what it does, it reduces the demand for that good, for gas, for example, and that allows us to show up at the station and still have gas. If prices didn't adjust, we would buy a lot, we would use a lot of gas, and we wouldn't have any at the pump. So the fact that the price is high, as unpleasant as it is reflecting the realities of the moment. Will they stay forever? Absolutely not. 2 years ago, price of oil was negative. Everybody was like, oh my gosh, this is forever. This is going to be horrific. No, 2 years later, it's over $100 a gallon. So things change in the economy. And to me, I'm not bothered by the fact that the prices are going up, because they are reflecting what is the reality at the moment. And the reality is going to change. A month from now, a year from now, it's going to be different. The second thing that is important to know about inflation is that in well-functioning markets, these prices, they do tend to actually work. The trouble is when the government comes in and then supposedly tries to protect the consumers. That's when we start seeing some issues. That's when inflation can really become an issue. And Vanessa, I was looking at a little study that we did, and we ranked all the inflation years over the past 100 years. And I had no idea, but what do you think was the highest inflation year that we've seen in this country? Going back to the 1920s. I had no idea. I had the wrong guess. But if you were to guess, what year would that be?
The 1970s, let's say.
Yeah, that's exactly my guess. 70s, maybe early 80s or something in that period. Well, that's what I thought. And in reality, the highest inflation year that we've seen was actually in 1946. And for a second, World War II, of course you have to do with the war. But then wait a second. War was over. Why was the highest inflation year after the war was over? What's going on with that? So I started digging, and it's such an interesting story, because what happened is in the early part of the war, as we moved from a civilian economy producing civilian goods to an economy producing for the military, what the government did is introduce something called the Office of Price Administration, the OPA. And this OPA basically regulated the prices that a restaurant can charge for a bowl of chicken soup, and how much is a can of beans, and everything was regulated in this price, and nobody can charge more than what was there. And in fact, consumers were asked, hey, please don't pay more, and in fact, report the offenders. If you see a restaurant that's overcharging you for a bowl of chicken soup, go ahead and tell us who they are. And that was supposed to help. The trouble is that you're not letting markets work. You're not letting supply and demand adjust the prices. While you're in the war, you had this almost like this mechanism that constrained prices. And in 1946, as you released the valve, the prices jumped, and we had the highest inflation year on record, and that was in 1946 at 18% inflation. So to me, it's interesting because it's when the government starts coming in and not letting the markets reflect the realities of the moment, that's when you start getting in trouble. The second example of that is something that I kind of touched on. In the early 70s, we mentioned that there are a few factors with transition from the gold standard to the type of money we have today, which is called fiat money. It's not tied to the gold. And also we had a situation in the Middle East when OPEC, the Organization of Petroleum Exporting Countries, it put an embargo against the U.S. And what President Nixon did, he actually put price controls on gas. And when he did this, I mean, the realities of what happened was you had a situation where you couldn't find gas. People were lining up for miles to get gas, and there was no gas. Because again, there was price controls that did not allow prices to adjust. So we could have gasoline and low prices and be happy about it, but would you rather have a bit of a higher price for gas or stand in this line? You tell me. So to me, again, I look at it and I do think that inflation will work itself out. People are wondering what's going to be inflation over the next 5 years or so. And there are two different scenarios, Vanessa. On one hand, investors, and by the way, this is disagreement among investors. One group is saying that this is transitional. Once you get past the pandemic and the restrictions like we have in China and the shipping issues get resolved, we're going to come back to a more reasonable inflation rate. Other groups are saying, no, companies are getting used to passing increases, consumers are paying more, workers are demanding higher wages, leading to higher prices, what's called the price-wage spiral. So we're going to have a longer running inflation at a higher level. And the truth is that today, nobody knows which one of these is true. And the thing is, folks, what I encourage you to do is not listen to any one forecast, including mine. I don't have one. I don't want you to read a piece and say, well, that's what's going to be inflation because that person said so. Instead, I really believe in market signals. And the market signal is different than a forecast. First of all, it doesn't belong to one individual, but rather it's a combined wisdom of a large group of people. But more importantly, a market signal is put through in almost like a referendum in which all these investors, based on their opinions, they're voting with actual dollar bills in the way that they buy different types of bonds. And there's a very clear metric that it's a market signal based on the way that investors vote with their dollars that gives us a clue onto what to expect about inflation, let's say, over the next 5 years. This metric is really well known among bond traders, not as much among individual investors, and it's called the break-even inflation rate. And this is the Federal Reserve website. It's a live website that looks at the 5-year break-even inflation rate. And again, since it's not a household term, let's just demystify it. So the value implies what market participants with different views, these opposing disagreeing views, what these market participants expect inflation to be in the next 5 years on average. So not a forecast, not one person's opinion, but rather the combined wisdom of people actually putting dollars to work. And if you look over the past 5 years, what you've seen is that inflation has been almost unusually low. The long-term average is 3%. And for many years, it was below 3%, almost half of it. And when the pandemic started, we had a different concern of prices not growing. Those are the realities of the moment. But as the economy opened, where we are today, in fact, as of last night, we can look as of Friday night, because we had Memorial Day yesterday. As of Friday night, if I can get the mouse close enough to Friday, let's just do Thursday. It's not that big of a deal. As of Thursday night, the expected inflation on average over the next 5 years is roughly about 2.9%. Let's just say 3%. In other words, what the market's expecting right now over the next 5 years on average is not the 7-8% that you hear in the news, but rather on average is pretty much the long-term inflation in the US. Pretty much it. That's exactly what the market's expecting. So if you are concerned about inflation, I would, go ahead and Google the break-even inflation rate. There's a value for 10 years. All these are market signal based on the way that investors deploy their capital. And this is a daily referendum because every single day there's information about the shipping lines and about supply chain issues and about wages for workers. All of this get put into this number. And what's so fascinating is that if you look at the beginning of the war, we mentioned the war in Ukraine, and this is on the 23rd, the day before the invasion began, the inflation expectation on average was pretty much like today, about 3%, spot on the long-term average. But as we understood a little bit more about the impact of the war, it went up all the way to about 3.6. But then instead of climbing, it just started dropping. And now, as I said, as of Friday night, it's about 2.95. So it's a good, to me, Vanessa, it's a good indicator for an investor to kind of get a sense of what the market expects. And again, these are not just the optimists or not just the pessimists. It's a combination of all these different views. Now, as an investor, it turns out that you already have probably a really, really, really good way to outpace inflation. Not necessarily today or tomorrow, but if you have a financial plan and you worry that, over the long run, will my investments actually stay ahead of inflation? It turns out that you do have that. And it's right there in the form of the stock market. Because when prices go up, it means that these companies to which we pay these prices, their revenue goes up. And to the degree that their revenue can stay up ahead of their costs, and that's been the case historically. What you see is that the stock market has been a good place to outpace inflation. So if you take all the inflation years from the highest to the lowest, and you cut it in half, you discard the lower half of inflation, and you only look at the above median inflation years. What's fascinating in the stock market, an investor would have received inflation back plus 4.9%. This number is called real returns. Real returns is above and beyond inflation. So in the stock market, you would have gotten the inflation back plus on top of inflation 4.9. And if you look at some of these large companies, the well-mature, well-established companies, you would have gotten inflation back plus 4.1. So not as much as the market as a whole, because the market doesn't just include the large, well-established, mature companies, but it also has as a diversifier instead of large, small, and instead of growth value. And what you see is that these small value have really also done a tremendous job in outpacing inflation because they deliver to investors inflation plus 12%. So you do have in your allocation right now some really good tools to make sure that you can stay ahead of inflation.
Great. Yeah, that's what certainly we've spent a lot of time talking to clients about that, how for the most part, there are mitigating factors already incorporated into their portfolio. You talked a little bit and touched on kind of market signals. Is there any market signals or any takeaways folks should have today on inflation and how it impacts the stock market? I mean, does it make recession inevitable? What actions to take, or is there any data that shows any sort of connection between these two variables?
Yeah, so there's actually one connection between the inflation and the stock market and the recession, and that connection is the Federal Reserve. The Federal Reserve is our central bank, and it kind of has two broad mandates. One is that we want to make sure that we have low unemployment. So people who want to get jobs, they can get jobs, and so the economy is humming and people have jobs. The second one is that the prices are not spiraling out of control. And that is controlling inflation. So, if you think about this mandate, sometimes there's tension between these two objectives that the Fed has. Because if the inflation starts creeping higher and higher and higher, and this has been the case lately, what the Federal Reserve might want to do is try to contain that inflation and make sure that it doesn't get out of control. And the way it does this is by increasing and just basically hoping to increase interest rates in the economy. And that's what you hear a lot about the Fed raising rates. And what happens is when the Fed is raising the one rate they can control, which is called the federal funds rate, which tends to be a baseline for a lot of other interest rates. And we'll touch on this because it's a very interesting thing. But let's just say when the Fed raises that benchmark interest rate, what happens is as interest rates go up, it makes it more expensive for companies to borrow. And they might have second thoughts about, do I really want to build that plant, to borrow the money to build something? So they might cut down on their purchases. So that relieves some of the pressure on the supply chain. So, we're not like everybody's chasing all these goods that are in limited supply. All of a sudden you start paring back and firms are not buying as much. It's the same with consumers. As interest rates go up, they find that their purchases start to kind of come down a little bit. And that reduces the pressure on prices. So one of the tools that you see is that the Fed raising rates, and when it raises the rates, the demand goes down, and that just releases the valve a little bit, releases some of the steam, so that the prices don't grow as much. And just today, there was, it's a very clear evidence for that. Just the concept. If you look at mortgages, as interest rates on mortgages have gone up, some of these folks are having a little bit of second thoughts of, what am I going to rebuild? Am I going to take a home equity line of credit to build something? It's more expensive. And what you saw today is that the price of lumber basically has dropped significantly in recent times. So that's kind of the idea that is behind the Fed raising the rates. The issue is that if the rates are too dramatic in the way that are increased, then the Fed might be able to reduce the demand and slow down the price increases, which is good. At the same time, perhaps run into the other issue that the economy slows down so much that we don't grow anymore. And instead of having growth in the economy from quarter to quarter, you see the economy shrinks. And that is the basis of a recession. If the economy doesn't grow and you have a certain number of quarters when it actually shrinks, then that's when you find we're in a recession. So the concern for some investors out there is that as the Fed raises rates, can it raise the rates to contain the inflation without reducing so much the demand that we run into the other problem, which is a recession? And that's the big question that investors are addressing right now. And again, there is this agreement among these folks. There are two things that I want you to understand, because I think they're crucial. The first thing is that investors are very well aware today that even though we're actually economically really well off right now in many ways, even as things look good, the stock market is forward looking. In other words, investors are really trying to assess what is the earning potential for Exxon and Chevron and Microsoft and Coca-Cola and Google and all these companies for years and years down the road. So when you run that exercise, you go beyond this year and the year after. And when the market is looking forward, it might say, today we're in good times, but based on what I expect the Fed to do, it's possible that we might have a recession. So the possibility of a recession is already baked into the prices today. And that's might be one of the reasons that the market has dropped, is because that possibility of a recession has already been priced in. And what's so fascinating, Vanessa, is that when the recession actually comes, that's when investors get really panicked. That's when they say things don't look good. Oh my gosh, I need to get out of the market because it doesn't look good. And I'll give you two examples of this. In 1980, it was a terrible year for the economy. I mean, if you look at 1980, you had a huge unemployment rate, about 8%. You had very low economic production. The economy shrunk by about 3%. Inflation was 8%. Housing starts dropped by over a third. And on top of that, the federal funds rate that the Fed controls actually went up by about 4.5%. So you have this sort of witch's brew of all the bad things. And if you're an investor, you say, boy, this is absolutely terrifying. This is not a good time to be invested in the market. It's the worst thing you can do. Well, it turns out that in 1980, the market was actually up about 32%. 32% in this year that looked like economically so horrific. And that's one example. The other one is 2009. We had the foreclosures. We had unemployment at 10%. Everything was terrible in 2009. And once again, that it was the worst economic year of the financial crisis. And at that point, a lot of investors are saying recessions are terrible for the markets. I need to get out. In the worst year of the economic downturn during the financial crisis, it turns out that the stock market went up about 26%. 26%. As a reference point, the long-term average of the market on an annualized basis is about 10%. So to me, Vanessa, the big thing that I want to caution people is that when you hear recession, that doesn't necessarily have to mean that it's time for you to sell, or not at all, because these expectations have been priced in. When the recession might actually come, it turns out that the market once again is forward looking, and that might be a good time to be in the market rather than to jump out. And the last thing I'll tell you is that I know, folks, there's going to be a recession. There's going to be a market downturn. You know, Vanessa was in San Diego and over like the last few days, and we know that San Diego, LA, San Francisco, California, at some point will have to deal with an earthquake, the same way that I know we have to deal with a market downturn. But that knowledge by itself is kind of useless because I just don't know when. What you don't want to do is live your life in fear of when it might come. No, I know it's coming, but what I need to do is be prepared. I bolted the house to the foundation. I tie the shelves to the wall. I have water in the trunk. So I'm prepared. And it might not be pleasant when it comes, but it's not devastating. It's the people who don't prepare that actually get in a lot of trouble. So because of that, again, even if there was a recession about to come, that does not mean it spells doom and gloom for the stock market. Not at all.
Sure. And that's kind of how we position that conversation a lot of times with clients is, you know, we want to build a portfolio that's going to serve you well in good and bad times, knowing that we're going to encounter both along the way. We just don't have that crystal ball to tell us exactly when it's going to come, what the magnitude is going to be, and you know, how it's going to get resolved.
Nobody can. It's not just you. Nobody can in the world. Nobody. Not even my crystal ball.
So what about, you know, we know we're in this period where interest rates, they're headed up, and, you know, that has posed some questions from clients on the role of bonds. And particularly with rising rates, we've seen that impact bond prices, particularly in the last quarter. We saw, you know, negative rates of return for bonds. So how do we think about what is the role of bonds, particularly within an increasing rate environment? And do we still hold them?
You know, yeah, it's such a good question because one of the things, folks, that has happened this year, which is a little bit unusual for the first quarter, is that we saw both stocks and bonds dropping in value at the same time. And that is a little bit, you know, unusual. You don't see that, like, at least investors, it just didn't seem that they were prepared for that scenario. So let me kind of address that. You know, should you still own bonds? Is there something wrong by the virtue of the bonds having gone down? And let me start with just a one quick comment that when you hear the word bonds, not all bonds are the same. And you should not treat all bonds as being the same. And one of the major delineating factors that came into play this year, the first quarter of the year, but historically as well, is that it matters a lot, something that's called maturity or duration. And what it means is that, how long is the contract of the bond? A bond is basically a contract. You lend your money to corporations and the government, and in the contract, they spell out an interest rate that you will receive. And at the back end of the contract, whenever that bond matures in technical terms, that's when you get your principal back. And it turns out there is a big difference between bonds that mature on the short term, let's say 1 to 5 years, versus the longer term. If you look at bonds that mature in the 1 to 5 year range, those are called typically on the shorter end. And you go back to over the past 30 plus years, there was a single negative calendar year when you would have lost money in 1994. And by the way, we saw that the bonds on the short end for the first quarter dropped about 1%. So, these short-term bonds can lose value, but now if you move into the intermediate bonds, and let's say 5 to 10 years or so, what you see instead of one negative year, you now have 2 negative years. And in 1994, the drop was not less than 1%, but it was roughly about a 2% drop. And if you go into the long-term bonds, then you see that once again, things change. Instead of 1 or 2 negative years, now you have 5 negative years. And 1994, the same year, these long-term bonds lost a lot more, about 7%. So the reason I bring this up is because the type of bonds that you had really in some way dictate what happened to you last quarter. The shorter end of the bonds, they're about the 1 year bonds were down maybe about 1%. The intermediate were down about 5%. The longer terms even more. So the first thing to note is that you can't, just say all bonds are the same. You have to be more specific, and you have to ask your advisor. I mean, all these bonds make sense depending on your goals and your financial plan. But it's good for you to understand what bonds do you own, and whatever you see on the news, it might not be exactly what your experience is. The second thing to note about bonds is that their primary role is to provide some counterbalance when the stock market doesn't do very well. So if you think of a sailing analogy, stocks are like the sail. They make it go fast, but they toss you all over the place. Bonds are more like the ballast. They're supposed to slow you down, but give you some stability. So in that respect, I think that the bonds absolutely have that role. And over the past quarter, some folks have said, yeah, but I have seen the stocks and drops as much as the bonds. So that is the case. For the first quarter, we did see this. And not just out of curiosity, I looked historically at the broad measure of the U.S. bond market and the S&P 500 and see, on a quarterly basis, how often do we see they drop? And it's quite fascinating. If you look at the stocks, and you ask how often on a quarterly basis, what you see is that about 27% of all quarters in the market have been negative, and the rest 73% have been positive. And we have about 185 quarters going back to 1976 or so. And these are for the stocks. What was interesting to me is that in the U.S., the bond market, if you ask the same question, I didn't expect this, but on the bond market, what you see is about 23% of all quarters are negative, which means that 77% are positive. But when I look at this on a quarterly basis, it seems like it's almost as often that you see stocks losing value on a quarterly basis as bonds do. So it's not infrequent for the bond market to actually lose value in any one quarter. And that was really interesting to me. But then, again, bonds should not be about only a quarter. Let's just extend that to an annual. And now what's so fascinating, and when you look at stocks on an annual basis, what you see is that they're down about 17%. Again, this is over the past 40 plus years or so. And the 83% they're positive. But the bonds now really started to take more shape because it's only about 9% of the time when you lose money in bonds, they're negative versus the 91% when it's positive. So to me, when I look at this, I was surprised a little bit to see that even as bonds have done a really good job on a quarterly basis, they tend to actually drop more than on an annual basis. So it's interesting that we see this. So I would be a little patient with bonds, and I wouldn't look at bonds and saying I'm giving up on bonds because they have not done well over the past quarter. I would say that bonds absolutely have a role. And you look at the times when the stock market dropped significantly. Take the first years of the century, 2000, 2001, 2002, significant drop in the stock market. 3 back-to-back significant negative years. In every single one of those years, a U.S. bond index on an annual basis actually held up really well. In 2008, we had a huge drop in the stock market, and the bonds actually held their own as well. So that's one of the main goals, is to have not only on a quarterly basis, but to have something in case the market doesn't do great. And historically, there is evidence to suggest that. It doesn't mean that the bonds never lose value. If you look in 2013, we did have a negative 2% drop when the market went up a whopping 32%. So it's possible that the bonds might drop, but by and large, what we see is that the beauty of the bonds is they do not move in lockstep with the stock market. And that's still the case. We absolutely still believe that's the case. And and that's why they ought to have for some people, not everyone, but for some people, bonds have a role in their portfolio.
Yeah. So when we look at building a portfolio for clients, certainly the stocks have a very specific, unique role. The bonds have a very specific, unique role. What about something, now you're hearing obviously lots of chatter about cryptocurrencies and assets like that, where they were initially, touted several years ago that they'd be a good hedge to inflation. We've kind of seen that really hasn't necessarily been the case. Is there any role, even if it's a small amount, that cryptocurrencies should play in a portfolio? How do we think about these types of assets?
Yeah, so cryptocurrency, for folks who are not experts, and I just like I have so many folks, even good friends of mine, really smart, who are just a little confused about this whole thing. Basically, cryptocurrencies came out about in 2009 when there was a degree of skepticism around the government, and we had the financial crisis. And what they really introduced was two interesting ideas. The first idea is that you can make direct payments from one person to another without really having intermediaries. Like if I want to send my brother some money, it has to go from my Venmo app to my bank to his Venmo. It's all these intermediaries, and money's like a bar of soap. The more you touch it, the less you have of it. So the idea was to can we transfer money directly, and that was the idea of an electronic money, and that was Bitcoin. And so it facilitates transfers. It makes it anonymous in some ways. So there are a lot of things that not under government control. There are things that the idea behind Bitcoin was were pretty interesting. But it also introduced something else, Vanessa, that's very interesting. Separate from Bitcoin, which is the electronic currency, it was the idea that what if we don't need to trust anyone? What if we can keep track of who owns what in a trustless world? Right now, if you go, I mean, you guys are in Frost Bank, and there's Wells Fargo and Bank of America, all these banks, and if you bank with them, there's a centralized ledger. And you have to trust the bank that they maintain the ledger to keep track of what you own. And what this Bitcoin introduced is something different, a technology called blockchain. And blockchain is a way to do record keeping and keep track of who owns what. But instead of a centralized ledger, it's decentralized. It sits on thousands of computers around the world. And the way that the ownership they kept track of was a very transparent way on all these computers. And the blockchain system is not really directed by any one person. It's a self-sustaining mechanism. So you don't need to trust anybody because the system itself is very robust. And it uses cryptography to make sure that all transactions are validated before they get written on these ledgers. And the reason I say this is that there are two very distinct tracks. One is blockchain, which is the technology, and then Bitcoin, which is the currency. And if you look at 13 years later or so, what you see is that blockchain is starting to get some commercial applications, and it might really be something to this technology. So blockchain is a technology. It's interesting. Bitcoin is not a currency that's being used. I don't know anybody who's used it. I don't really know a lot of drug dealers and kidnappers. But the thing is that Bitcoin right now is not really used for transactions. So in my view is that Bitcoin doesn't really have as much value, but blockchain does. And blockchain is now being used by different companies from large to small, and it is part of your portfolio in a diversified allocation. Bitcoin, on the other hand, I don't believe that it's worth investing as part of the plan, because as opposed to stocks and bonds, which have a way of being valued, and like you look at a stock, well, what are the earnings? Should I, how much should I pay for it given what I expect the company to make? That's a way to value an investment. And as investors, I think it's crucial. Bitcoin only has value because you believe that somebody else is going to pay more in the future. Why? Nobody can tell. And that's the definition of speculation. So to me, I wouldn't put it as part of a portfolio, but rather I would say there are three reasons you might want to get Bitcoin. One is if you want to belong to that community. These are free thinkers, they're libertarians, and if it speaks to you, you want to be part of the community. The same way that the meme stocks, Vanessa, I don't believe they're an asset class because of the type of investments. They're an asset class because of the type of people that attracted around them. So I think Bitcoin is the same as an asset class because of the group of people to which you belong. And if that's something that you're interested in, people spend money on worse things. The second one, if you find that you really like Bitcoin as a commodity, like a trading card, like if you have a baseball card and you paid a lot of money for it, this could be in the same category. And thirdly, I really think that some people look at Bitcoin as a way to almost buy a dream that you know, hey, I'm going to change my wealth status because it's going to make me a lot of money. So I think that if you are in these categories, if you took on the side a few dollars there, here and there, and put in Bitcoin because of one of these three reasons, I don't think there's anything wrong with it. I think that it doesn't make sense as part of your financial plan, because I don't see how this will help you achieve your goals with a less amount of risk. I really don't see it, because whenever you think of the money you can make, there's so much money to be lost.
Yeah.
But there's one other thing, and I don't want to get too carried away with this, but Vanessa, what's interesting is that there's so many players who have come out to make money out of this. And in fact, people are getting into Bitcoin without really realizing the risk that it's involved. And I'm not talking about the risk of losing money because the price of Bitcoin crashes. No, I'm talking about something more fundamental than this. If you own a stock or a bond, and you use a platform like Schwab or Fidelity or TD Ameritrade or Pershing, there's all these platforms. Basically, your accounts are segregated, and if, knock on wood, something happens to these platforms, you would get those shares because they're yours. They don't belong to Schwab or Fidelity or anybody else. They belong to you. So if something happens to Schwab, that's not it. But here's the thing that a lot of people, I'm not sure they fully understand, and it came out about a week or two ago. If you own Bitcoin through a platform, and I'm not going to name names, some of them are publicly traded stocks, so they're big companies. The thing is, in order to own Bitcoin, you have to have a wallet. And the wallet, it's only a numerical wallet that it doesn't have any identity attached to it. So what these entities are doing, they're opening these wallet on the blockchain so they can buy Bitcoin, so they can get Bitcoin. But here's the thing. If they get in trouble and those companies go bankrupt, you don't own Bitcoin because you don't have the wallet. The wallet belongs to them. So recently, these companies added disclosures on the website is that if we get into trouble, litigation, bankruptcy, then the creditors can actually go after the Bitcoins that we hold in wallets, which you thought they're yours, but in fact, they might not belong to you. So the risks associated with this are so fundamental that I'd be very cautious. There's no regulation around it yet. I'd be very cautious.
No, but it's the Wild West still, and
it's a Wild West, and I got to tell you, like, I'm really concerned that some of these platforms that as the Bitcoin mania is dying, and if they're not surviving, and all of a sudden you thought that he owned Bitcoin, but in fact you didn't, because that is not specifically under your wallet. I think a lot of people are gonna just do a run on the bank like they did with other Bitcoins, other stable coins recently, and it's gonna end in disaster for a lot of people. So I'm I don't want to spell doom. I'm a positive guy. I just have really grave concerns about people piling money into something that is so risky and unregulated.
Sure. Well, great. Well, wow. I just looked at the clock and it's already 1 o'clock. We certainly did. We covered a wide range of topics. I know we could probably go on here for another hour or so, but this has been, I think, really helpful. And these are just things that are on all of our minds. There's a new crisis du jour every day, and we just need sometimes that extra dose of vitamin C to help us think through, like, how do we reposition ourselves to be a long-term investor? How do we put it in perspective? And you're always so wonderful at helping us do that. So we certainly really appreciate the time. And, if folks do have questions, again, feel free to submit those to us or to your advisor, and we'll be sure to address those for all of you. But again, thank you so much, Apollo. This has been such a treat.
Same for me. Thank you so much. Great seeing you, and thanks for the invitation, and look forward to working with you again.
Yeah, likewise. Thanks, Apollo.
Bye-bye.